Okay, before we jump into our weekly outlook, it is coming up on Christmas time, so we have our hat sale returning. It'll be somewhere near the end of November to December 10th. I'm not exactly sure what date. And we sell our hats, and I match the proceeds from the sale of the hat, and we donate that to a charity that focuses on kids. Last year it was Big Brothers Big Sisters. We had a target of 25,000. We were selling hats. At that time, we were selling them in Canadian dollars. This year they'll be in US dollars, so they'll be a different price. But last year it was $30 Canadian, and I matched it with another $45. So for every hat sold, I took that 30, added 45 to get to 75, and we donated it to Big Brothers Big Sisters. So every time you buy a hat, I then add some of my own money in there to get our target price. We did make the donation of $25,000 last year to Big Brothers Big Sisters. This year, our target is on the screen, Pathstone Mental Health. And you can see in white writing there, mental health care for your child today prepares them for tomorrow. The link for this site is the first link in the description box below. So you can go to the site and you can see exactly what they do. They have services for families, a whole section about who they are, the services that they offer, and you can donate as well. I would suggest you hold off on the donating for now because they're going to add a not a link but a descriptor for your donation so that you can select this particular program so that they know that your donation came from me suggesting that you donate. We can only ship hats in Canada and the US because shipping hats outside of North America is super expensive to the point that it's just not worth it. It would cost almost $200 just to ship a hat to Europe. That's just the shipping. It is ridiculous, the cost for shipping. So we restrict it to North America, and even in North America, I'm not comfortable with the shipping cost because sometimes, depending on where it's going, it's almost as much as the hat itself, which hardly seems reasonable. But we're at the mercy of shipping companies on that one. If you're outside of North America and you do want to do something, I would, at the time, when it's ready, I'll put the link for the donate so that if you do feel the need or the desire or the wish to donate to this service, you can. So look for that. I'll give more information as we get closer, but it will be, I want to say December 1st to December 10th, but I'm pushing them to give me any of the days you can in November. And we will sell all the way to the 10th, and then we will ship them all on one day. And we used to ship them every day, but it's hard to organize the volunteers because we use high school kids to do all the shipping because they need volunteer hours. So we use them for this, and they satisfy their volunteer hours, and they're working for a good cause at the same time. It's easier to get them all in one room at the same time, and then they pack and ship all of them. They spend the whole day packing and shipping and getting their hours in. So if you buy early, just be aware that it will not ship till December 11th. That gives plenty of time in North America to get to you before Christmas. So I will have more information on that as we get closer to the date when the when they are available for sale. But if you want to have a look at this site, it's the first link in the description box. Okay, let's begin our weekly outlook. Looking back, looking forward, what a week it was. The midterms happened, and again, the polls had it wrong. It's hard to rely on polls anymore. There was no red wave. The Republicans didn't take over the Senate. We learned on the weekend that Democrats still maintain control of the Senate. So it didn't work out as well as what the polls would say, or as well as what the Republicans would say. And it seemed that the candidates who were winning were more centric. Good. This is finally a good thing. I don't care which party really runs the country, as long as they run the country from the center. Once you start getting out into the wings, the far right or the far left, it's going to be wrong for the majority of people. So thank God that happened. I look forward to seeing what happens. But you are going to have a Congress that is probably going to do nothing. Same thing we've had for the last how many years now, so I don't know that anything much has changed on that one. Let's have a look at what happened to rates. That's the big story, because I think this week we did, I don't want to use the word pivot, but we do have a significant change in the way we are going to be analyzing markets from here on in. That the rate hikes are going to take a back seat. Not that they're important, but that it is a little bit more clear that we're near the end of this rate hike cycle. We were near the end of it anyways without the CPI print. The CPI print was in the right direction, but not so much so as to be an anomaly. That if it were this really outlier print of zero inflation, well, that usually doesn't hold when you have big volatility from month to month in the measurement. This was a measurement that was month over month, came in better, but low volatility. Not so much better as to be an anomaly, but better as to show that what has been done so far is having the desired effect, so as long as we hold the course. The bond market was closed on Friday, so we don't really have the benefit of seeing whether or not the big drop in yields on Thursday had any give back for Friday. You could look at the futures market, the Treasury futures market, but the moves were small and you can't really read much into that. So all we have are bond yields as of the close of Thursday. No surprise there. Look at them all dropping right across the board, except the front end are really dictated by the Fed rate at this point. It's once you get into the capital market rates, they've all dropped across the board. FOMC minutes in 10 days. So it'll be interesting to see what they were talking about, but, it's always a little historical, right? If this CPI print came in hotter than expected, then those minutes were going to be really, really important. But CPI came in lighter than expected, so whatever they were discussing at the time, they were discussing under the context of inflation is going in the wrong direction. So we'll see what they were talking about there. Next FOMC meeting, December 14th, that's 31 days away. We don't have a lot of information between now and then that can change the sentiment in the market right now. We've got some earnings this week on retailers. I don't know that that can change too much unless it's really, really dire. But from here on in, this market is probably going to trade on sentiment and within wide ranges. So I don't know that I would be too eager to fade this rally. And as I said a couple weeks ago, that I thought November would be the last good month for volatility, for implied volatility on the S&P as far as premium in the options, and the market hasn't let me down. And I think we have hit a turning point in how we are going to be looking at asset prices. Let's continue on here. Our 2 to 10 is inverted, negative 52. That's 130 days now. And if we look down here, we see the 3-month to the 5-year is now inverted. The 3-month to the 10-year is even more inverted. That's been 18 days. Remember, this has a 100% track record so far. So the change, look at these big changes over here. That's mostly because your short-term rates up to your 3-month are going to be pegged by the overnight rate, which is sitting at 4%. But any change in expectations going forward are going to show up in capital market rates. So if capital market rates are going down, but the 3-month is anchored because of the Fed funds rate, that's where you're going to get the biggest inversions, and we are inverted there. For December 14th, last week, we had probabilities, almost even odds, I shouldn't say even odds, even probabilities for a 50 or 75 basis point hike. Well, that is now gone, the weight of it. 83% is on the 50. I think they were going to go 50 anyways because it just seemed like the language from the Fed this past week was suggesting that 50 was in the works. Some talking from some Fed officials saying, we really can't keep going at the rate we're going. We are thinking, 50 makes a lot of sense. But that 50, still preparing you that, but 50 is still going to be a big hike. Don't get too excited, but I think they at this last meeting, they were probably already on the page of 50 anyway, so I think that's pretty much a lock at this point. I don't see that the PCE reading coming in at the end of this month is going to disconfirm what we saw in CPI. We do have one more jobs report in December before the December 14th meeting. I don't think that's going to change anybody's mind, but you do have another CPI reading before the December 14th meeting. You do have another CPI reading, and if it's like this one, if we still see another step down, you might even see a 25 basis point probability show up. In fact, you might even see 25 basis point probability show up over the next week, depending on what the Fed speak sounds like. But we are, as I said a couple of weeks ago, we are near the end of this rate hike cycle based on my best guess, based on this reading. As long as nothing happens to change what this reading looks like, yeah, I think we are a 50 and a 25 away from being done, if not a 25 and a 25 away from being done. But I don't see 75s unless December comes in so hot that they have no choice. But it just doesn't feel that way based on where the prices are going. Fed balance sheet ending November 9th increased by 26 million. That's a rounding error when you're talking about 8.156 trillion, right? So no change week over week. That's because nothing matures during those particular 2 weeks. They're 2 months, 2 times a month, where your mortgage-backed securities mature once a month and your treasuries mature on another date of the month, and that's it. Fed funds rate has really changed. Now the low point on the index, 95.12, which implies a rate of 4.88. May and June are identical at 95.12. Last week it was June at 94.9, implying a rate of 5.09. Now the peak rate is the Fed funds futures pricing in a peak rate of 4.88% as opposed to 5.09, which is 21.5 basis points lower, which is a full 25 basis point rate hike lower. The terminal rate for end of 2023 December index 95.54, implying a rate of 4.46. Last week it was implying a rate of 4.85, so that's about 40 basis points lower, 39 basis points lower than where it was last week. So this last CPI reading had the effect of lowering capital rates significantly. Most of this is a one-day move, by the way. Lowering rates significantly, raising the probability of 50 basis points, bringing the end of the rate hike cycle closer, lowering the peak rate, and lowering the rate at the end of 2023. Okay, real yields all down. I don't think that's surprising. Break-even rates all down. Not surprising as well either. Let's just make sure we understand what this number means. It's called a break-even rate. It's also called an inflation expectation. So if we expect, if we wanted to buy a 5-year bond today, we have a choice, right? We could buy a nominal bond or we could buy TIPS. If we expect the average inflation rate over that period of time to be 2.47, we are indifferent between either one. If we expect the inflation rate to be lower, we would rather have the nominal bond. If we expect it to be higher, we would rather have the TIPS. So the bond market looks at these break-even rates and then makes a decision. Do I want a nominal bond or do I want a TIPS? And based on that break-even rate, they make their choice, such that that break-even rate can be interpreted as an inflation expectation. So if we have a 5-year inflation expectation of 2.47, a 10-year of 2.39, notice that it's lower. We can calculate the 5-year forward, 2.31. That is a measure of the amount of embeddedness that inflation is taking hold in the economy. When that starts to increase, that is down. That's exactly what the Fed would like to see. They can make a conclusion that inflation expectations have not become embedded yet. Let's have a look at the initial claims. You see the progression here from October 8th, 226, the week after 214, 218, 218, 225. These changes aren't very big. I don't really see any stress there. This is our first look at November. As 225. We've got the rest of November to look at. That will give us some clue as to, well, what do you think we'll see in December? And as long as it stays low, 220, 215, 225 throughout November, December is going to print a positive jobs report. If we start seeing it get to 275, 300, 325, well then that's the job market deteriorating rather quickly over the span of 1 month. I don't know that I would expect to see that. You can point to, well, there's a lot of tech layoffs that were announced over the last week, and you're right, there were a lot of tech layoffs. But there's also a lot of openings. I know this for a fact, that there are companies that have a standing order to hire any tech people that they can if they can get good people. It's just you couldn't get good people. Those people will be snapped up in the market very quickly. I don't anticipate that they're going home and going to be sitting on their couch for the next 2 months because they can't find a job. They're being released into probably the healthiest job market they've ever seen since 1999, 2000, since the dot-com boom, where you couldn't get anybody. You couldn't find a coder anywhere. If you were a coder, even if you heard of coding, you could get a job as a coder. So I don't anticipate that all of those layoffs are going to show up in initial claims. You may have some people who say, you know what, the job market's good. I'm going to take the rest of the year off. I've got some money I can float. I'll get unemployment for the next 2 months, and then, I'll go back to work in the new year. You might get some people doing that, but for the majority of them, they'll walk across the street and they'll just get repriced. If they haven't already got another job already, 40, 50% of them, if they haven't already got another job already, it just means they didn't even look. But most of them are going to walk into another job somewhere else. Let's look at the Atlanta wage growth tracker because we had the November jobs report that takes the Atlanta Fed a couple of days after that to break down the data in terms of where the wage gains are happening. So it's a measure of wage inflation. August, September, October, 6.7 down to 6.3 in September. Yet we saw inflation increase, 6.3 to 6.4, yet we saw inflation or CPI decrease. But it's important to note it did go up to 6.4. The job switchers taking a hit, 8.4 down to 7.9, now down to 7.6. It's when these two are identical that you have employees who are saying, well, there's no point in me quitting here and getting a job somewhere else for the same money. The only reason you would switch at that point is if you were unhappy in the job. But switching purely to bump your pay would disappear. There's still some benefit in doing it, but it's that gap is slowly disappearing. So when we look at the JOLTS report, we get two things in there. We get openings and we get the quits rate. Openings, well, is it real or not? We don't know. Is there a lot of double and triple and quadruple counting going on? Does a company have, two different job postings for the same job or 3 different job postings for the same job to try to capture the biggest or cast the widest net possible? Yeah, probably. The quits rate is more important. It's been elevated in over 4 million for quite some time. As soon as it drops below 4 million, if it prints a 3 handle, 3 anything, it is going to be a very bullish signal for the market because that is the job market loosening up. It is suggesting that employees are not that comfortable quitting their job anymore because they're not that confident, or at least they're losing confidence in being able to find another job quickly. At over 4 million, that signals a high level of confidence. Well, if you have this going on, if this continues on, it becomes less profitable to do it. You'll still have job switchers. There are still lots of people out there who hate the job they have, who hate the boss they have, who are in dead-end jobs, who got passed over for a promotion, who have no growth, whatever. There's always going to be job quitters. But what you want to eliminate in the job market so that you can have an abatement or a reduction in wage inflation is people quitting jobs purely because they can get more money somewhere else. Well, that gap is narrowing here, 5.6 to 8.4. Now we're 5.4 to 7.6. This has only dropped from 5.6 to 5.4, but 8.4 down to 7.6. Once this gap is closed, that's going to be quite bullish. And as soon as you see, when it closes, you'll see this quits rate come down quite significantly. Okay, let's have a look at the CPI report. Table 1 really is the big, interesting table you would go to first. It's the big top-down table you would look at, and then you can go into all the other tables and dive deeper into each specific category. If you are holding companies in a particular subsector, you might want to go and see what kind of inflation or deflation they're facing. Deflation in a particular sector is not a good thing because that means revenues are falling. However, their costs may not be falling as quickly because wages don't go down. They just don't go up by as much, but they still go up. And we saw with the wage tracker that wage inflation is coming down, but inflation it still is. In this report, you will find some categories that don't just have slowing prices. In other words, disinflation. They're actually in right out deflation, which means their revenues are going to be dropping, but their costs are not going to be dropping as quickly. So you might want to look to where the negative signs are and ask yourself, do you have any exposure to those particular sectors? Because you're going to get margin squeezes. So what do we have here? All items, headline here, month over month, 0.4. And that breaks down into headline, which is everything. You can strip out food and energy because they're volatile components that sometimes are unrelated to the economy that you're in. And you go down to all items less food and energy, a weighting of 78.28. And this breaks down into goods and services. The first item you get to, commodities, less food and energy commodities. This is the goods sector of the economy. And down here, services less energy services is the services side of the economy. So read across the goods side of the economy all the way across, negative 0.4. It is showing deflation. That is not disinflation. Disinflation is going from 0.6 to 0.5 to 0.4 to 0.3. Sure, prices are going up, but they're going up by less and less and less. That's disinflation. This negative sign is deflation, negative 0.4. If you have exposure to any car companies, new vehicles still going up in price, 0.4, but you have significant disinflation here, 0.8, 0.7, 0.4. Once that gets into deflation, I don't know that the car companies are going to be attractive for a while. And it would get into deflation if you fix the supply channel and suddenly there's no supply issues. And that the car companies can now not only sell every car they make, but they can produce every car that's demanded. So you would get to a point where you can supply all of the demand. And dealership lots would start to fill up, and then you'd get rising inventories, and suddenly you have more supply, or you have the capacity to produce more supply than there's demand, and that always starts a price war. So I would be watching that number, and with a soft economy coming up, most think that a recession is still ahead of us. I see that number negative. I don't want to be near these companies because they are going to produce to meet demand because it's what you should do because that's what your competitor will do. And you better do it if you want to maintain market share. And when you start overproducing, well, you're going to have dealer incentives and you're going to have some kind of margin hits because everybody's going to do that. So watch that number there. Look at the disinflation in used cars and trucks, negative 0.1, negative 1.1, negative 2.4. That is called accelerating deflation. Accelerating deflation. It won't be long before you start to see it happen to new cars as well. But you have deflation in the goods sector. That's a negative for revenues because, well, how do you get deflation? Lower prices. Well, that's your revenues, right? That is your revenues. Now you can say, yeah, but you can have lower prices and make it up in quantity, that you can just start selling more. Well, that's really what you've got to hope for to maintain margins. If you have a subsector where you can dive into these tables and look at the subsector you have exposure to, you see a bunch of negative signs, then you have to say, okay, I know revenues will be lower unless quantities are higher. And that means they have to push quantities higher just to equal zero growth in revenue quarter over quarter in face of deflation, but their wages are still going up at a slower rate, but still going up. You're going to have margin compression in that sector. Look at shelter, less energy services here. You're at 0.5. And the only place we see a negative sign here is in medical care services. Good. Airline fares are coming down as well. But what is keeping inflation alive is inflation in the services sector. not in the goods producing sector. So we should see something like this in the market, where if we're looking for equity price increases, we should see more in services-based companies than we see in goods-based companies. I'd be hesitant to be jumping into goods-based companies now. For the week coming up, we have 5 retailers reporting. This report is for the month of October. The quarter that they're reporting for is September 30th. So I don't know that we're going to see much in their numbers reflecting goods deflation to this extent over the month of October. However, it's going to be important to listen to their guidance. So, I think you have Walmart, Home Depot, Target. There are 5 big retailers reporting this week that I think would be very useful to get that 10Q and go to item 7, which is usually the MD&A, management discussion analysis, and look for any kind of forecast that they're making, or listen to the conference call, because analysts will be asking questions about that. And if there are 5 companies, that's 5 hours of your time, right? Okay, let's head over to Cleveland Fed here and look at the median and trimmed CPI. These numbers were updated November 10th. When it says here September 1st and October 1st on the chart, the date for September 1st is the month beginning September 1st and the month beginning October 1st. So it's not that this is numbers that we saw on October 1st for September. These are numbers for the month beginning October 1st, 2022 that we got in November. If we take the Bureau of Labor Statistics report and look at CPI and core CPI and look at the month over month and annualize it, CPI was 0.438% month over month. So annualized is 5.39. Year over year on a backwards looking basis was 7.7. Actually, it tells us right here it was 7.75. So year over year on a backwards looking basis, 7.75. But if we take the month over month and we annualize it, you get to 5.39. Well, that's in the right direction, downwards, right? Core CPI month over month, 0.2715. They reported as 0.3 because, of course, they don't want to give you the extra bit of information. 0.2715 annualized is 3.31. A backwards looking year over year on core, 6.28. 3.31. Almost half of what it was. These, no matter how you look at it, these are promising numbers in terms of, if we're just thinking about the fight against inflation, these are promising numbers. But let's not forget, we still only have one data point. But this one data point, as I've already said, is not so far outside what we would expect to see as to be a potential anomaly or an outlier or a measurement error. It seems to be consistent with, it should be working by now. These rate hikes should be working by now, and we're seeing it come down. Not a lot, but it came down. That's promising. That gives more credibility to the idea that it could continue. So what I've done is I put the 3.31 and the 5.39 in here. This is 3.31, 5.39. Here's where we are, and this is the trajectory that if it continues on, we would see that kind of trajectory in our year-over-year measure of inflation. Still elevated from the range that they like to be in, still elevated, but certainly they would not be hiking into a trend that looks like this. They may be on hold, but certainly not hiking, which sort of adds to your thesis that, if you have the same thesis I have, that we are pretty much near the end of the rate hiking cycle. Maybe another 75, maybe another 50, but I think we're pretty much done. So we can start looking to that as the next regime that we enter, is not rates going up, but rates at a certain level and staying at that level for a period of time, and start thinking about what effect that's going to have. Have a look a little bit deeper here. This is why we use the Cleveland Fed here. The median, 6.98. And in the CPI report we saw for November, for the month of October, the median was 7%. That went up. That did not go down. It went up. So the idea that the Fed speakers have been saying one data point is not enough. I'm sure they'll point to that, saying, look, the median inflation did not budge. In fact, it went up. So no, we are not done, and one is not enough. Because here's the thing. Financial conditions loosened significantly last week. Wait till I show you what happened to mortgage rates. Wow. That's not going to be what the Fed wants to see with one data point. They're not going to want to risk financial conditions loosening and that inflation going back up again because of that. So they're going to talk tough, but they need some data points to talk tough. Look for them to mention this. It would not surprise me if this showed up in conversation somewhere, that the median CPI did not budge, in fact went higher. The trimmed 7.31 down to 6.95. That did come down 0.36. You look at CPI 8.2 down to 7.75. That is 0.45. And core CPI 6.63 down to 6.28 is 0.35. In line with the trimmed. But it's your median that if you had to point to something bad in this CPI report, you got to point to median. And when I say bad, it means in terms of when we think the Fed is done. That's the only negative that I can find. If you're thinking about, well, what is bad in that report, the deflation in the goods sector is bad for earnings in that particular sector, because if you have deflation, the only way to have deflation is if prices are dropping, which means revenues are going to drop unless quantities increase. Change in median CPI, 0.5 in October. Change in 16% trimmed mean CPI, 0.4. Change in core CPI month over month, 0.27. Okay, let's have a look at our mortgage rates. They have really dropped. The 30-year fixed 6.62 was 7.29 the week before. Thursday alone, 60 basis point drop in the 30-year fixed. Remember, the bond market was closed on Friday, so you're not going to have any changes here. 60-point drop on the 30-year fixed. Look at the 30-year FHA, 6.2 versus 6.84. Roughly about the same thing, a 60-point drop alone on Thursday. Not really what the Fed would like to see. I'm sure they were aware that, listen, if CPI starts coming down like it should, because we are raising rates, we should start to see it come down. The market is going to, celebrate that, and they will move rates in a direction we don't want them to go. We already saw capital market rates have already had, as much as a 25 to 30 basis point cut. Let me just reverse here and have a look at the first screen. You had at least 35 to 40 basis point cut right across the board. The 10-year had a 35 basis point cut over the course of the week. Now, I say a cut. The market has traded the 10-year such that it is the equivalent of a 35 basis point cut. So you basically had the market doing a whole bunch of rate cuts all over the place. 35 basis point rate cut on the 10-year, 60 basis point rate cut on the 30-year fixed rate mortgage. That's not what the Fed wants to see. That will work against the trend that they believe that they have going. Yeah, we saw a drop in inflation, but only if we continue to maintain the tightness that we have. This loosening, not going to be such a good thing. So I would be interested to see how they're going to deal with this over the next week. They got to come out. They got to talk tough. Expect them to say, it's 1 point, people. It's one data point. That is nowhere near enough. And we are nowhere near done. I think they'll say those things, even though I believe they are near done. They cannot let the market get too happy about that. Otherwise, you're going to see this drop, and that is working against their wishes. I was asked on LinkedIn why I use Mortgage News Daily, that these rates don't seem to match the mortgage market survey rates, and they don't. Mortgage News Daily uses actual lender rates. This is survey based. So they'll be close, but not exact, and I think that the actual lender rates make more sense, so I use that. You can see the difference here. The 30-year fixed rate mortgage, 7.08 versus 6.62 if you're using actual rates. Everything else is fairly close. The 15-year fixed rate mortgage here is 6%, 6.38, a little bit closer, 6.06 here versus 6.12. It's close, it's in the neighborhood, but it's not exact because one, just like I say, uses the actual lender rates, the other is survey based. Based on Redfin data, this is Realtor.com down here, this is Redfin up here. Look at median listing prices, 14% down to 13, down to 12, down to 11.7. So your listing prices, sellers are more willing to price their houses such that the growth year over year is dropping. Median listing prices based on Redfin data, 359, 250, which is 3% year over year. Realtor.com is registering 11.7% year over year. New listings down 20%. Redfin has new listings down 17% year over year. That's fairly close. And time on market 8 days slower year over year. Realtor.com 7 days slower, so that's kind of close, but these numbers are off on these two. The end result here is that, look, your active listings, 36, 40, 42. Supply is increasing. It's taking longer to sell houses, and year over year the price increase is dropping and dropping. Still double digits. Once this drops below 10%, that's going to be rather interesting to see. But this is showing the median listing price on Redfin up 3% year over year. So I haven't dived into, well, how do you measure this and how many listings do you have versus how do you measure this and how many listings do you have to determine, well, which one would be more representative. I leave that to one of you out there. If some of you know more about Redfin, the difference between Redfin and Realtor.com, put it in the comment section. Okay, let's look at three big macro indicators here. The DXY, the dollar index. We'll look at VIX, and we've already seen the 10-year U.S. Treasury. And they all have some meaning here. Look at the DXY. We had this support last week. I showed where we had a line of support and resistance, and we had sort of a wedge formation, a consolidation pattern forming. Well, we have a clear breakdown below that. Our next support level, the best support level we can find, is 105.50 to 105.20, and we're sitting at 106.29 on the DXY. You can't even draw a speed line here because there is no bounce off of that. It's just a straight line down. So who knows if that's where it would be. Until you have a rebound from that, you can't draw a new trend line. So all we can do is just look at, well, where would be the most obvious place of resistance, and I don't even know how strong that is, but 105.50 to 105.20 in that range down there. We're at 106.29. So DXY is below support. If we have a look at the VIX, it is sitting at 22.48. You have support at 21.60. And how we interpret the VIX, resistance on the VIX represents a buy signal on the market. Support on the VIX represents a sell signal on the market. Be careful here, because if you get a breakdown below here, then that sell signal is not going to be valid. So watch this. If this continues in this direction and this continues in this direction, I would not be shorting this market in any way. Because sentiment is going to rule the day. The 10-year U.S. Treasury we saw has pulled back. I think we're near the end of the rate hiking cycle. No matter what the Fed says this week to get you to back off of financial conditions, I do think we're near the end. So I think the 10-year high has most likely been put in at 4.25, which is October 24th. And as long as, we don't need to know where the 10-year is going to go. As long as the market starts to believe that the high for the 10-year is in, they can start making decisions, capital allocation decisions based on that they don't have to worry that, well, we're going to go from 4.25 to 4.5 to 4.75. Now, I'm saying belief, that if, the market may begin to believe that the 10-year high is most likely in. And if that's the case, then they'll act in a certain way because that belief will lead to action. But that belief does not necessarily mean that the 10-year high is in. It's just the belief that it's in. It could go higher. We could find that in December, CPI is suddenly 200 basis points higher, comes in at 9.9 or 9.5 or 10. and that it's actually even worse, and that what we saw was just a small little reprieve before the worst of the worst came in. We don't know. But based on where the indicators are going, DXY dropping, VIX dropping, 10-year yield dropping, none of those things are signaling that we have a potential short on the S&P right now. None of them. Until they start to turn around, if we start seeing the DXY, bouncing along 105 and then slowly going up, and we see the VIX finding, support at 21.6 and then returning up, and yields on the 10-year going up, if you start seeing that, then you might think, okay, well, what's the sentiment in the market? What's the conversation about? What's the main theme going on? What's the narrative saying? And if that sounds like they're worried about something bigger, then that might imply that you have a short on the S&P. But right now, as long as those three indicators are pointing downwards, I would not be opening new short positions on this market. Also, the other thing that I expect is going to happen is correlations are most likely going to drop now. So when you have stressed times, let's draw a circle and we'll put a whole bunch of stocks in there. Right? And there's always correlations between stocks because they have a common factor, which is beta. And since they all have a common factor, they'll all be correlated to some degree. But in times of macro stress, which means there is something at the level of the whole that is stressing the whole system, correlations in here all increase, which means you now have a stock market. You have a stock market, and it makes sense to use a market index or an ETF like SPY to hedge all your individual positions, because correlations among all your individual positions with SPY are very high. So any hedge on SPY ends up being a good hedge for your portfolio as a whole. However, once that macro stress disappears, which has been the pace of rate hikes, that's been the big stress all year. Once that disappears, I think that narrative is probably going to fade to the background. Yes, there'll be some rate hikes, but that pace is going to be much more subdued, and we're, like I say, 50 to 75 basis points close to the end. Even without the last CPI reading, I think we were 50 to 75 basis points close to the end, because you do have to consider the fact that, listen, we've raised for a long time and very high. Why not just let it do its job for a while? Let's go sideways and see what happens. So what is going to happen is, because of that, I think these correlations are going to drop. And if these correlations drop, then using the SPY as a hedge against all of your portfolio becomes less and less effective because the correlations are dropping. So I do think that we are in I don't know where we're going in the market really. You have some idea of in the short term where we're most likely to go, but in the longer term, I'm still not quite sure yet. But what we do have, I think, this month is a shift in the way we have to look at the market. We are moving from a stock market to a market of stocks. And that means that we, up to now, we've been very top-down in looking at the market. Our top-down is going to have to shift into other indicators, but we're also going to have to start thinking about bottom-up, which means as these correlations start to drop, individual stocks will then begin to trade on their own merit as opposed to their beta. And if that's the case, we want to try to figure out, well, what sectors make sense, what stocks make sense, because now we're moving away from this stock market, and now we have to become more of a stock picker, so bottom up is going to matter. So the correlation between SPY and single names, I think, is going to drop. So stock market is shifting to a market of stocks. So we have to shift from a pure top-down analysis to a blend of top-down and bottom-up. We have to start introducing some bottom-up analysis. So we do have to start paying attention to other headlines now and other things that are going on. And it's about time. It's almost like a breath of fresh air, because for how long have we only been concerned about one story? The Fed. It's the Fed. Everything was the Fed. And we looked at every data point in terms of what's the Fed going to do? What's the Fed going to do? Well, I think we can start looking now at other indicators and say, what's that going to do for this stock? We could ignore that before. What's this going to do for that stock? Because it wouldn't matter. It's all about the Fed. It wouldn't matter if this was good news for this company. it's all about the Fed. Everything will sell off if we think the Fed is going to raise another 75. Well, I think that's going to fade to the background. So now we do have to move away from just a single story. Thank God. And I'll tell you, because it was just getting a little boring week after week. What's the Fed going to do? What's the Fed going to do? I was getting bored with the whole thing. So it's nice to have a new game to play. So now we're going to start paying attention to more granular stuff, more headline stuff, and wondering, well, what effect is that going to have on what parts of the market? And then start to pay more attention to some bottom-up stories that might be interesting. Okay, so we'll look at a number of different bullet points here. And, we need to be aware that these things are going on. By the way, this kind of change in outlook, moving away from something that's worked for a while, which is using the S&P to generate extra premium and to hedge our positions, it's sometimes difficult to make those changes in the regime and what you do, because normally we don't leave a profitable trade while it's profitable. We wait till it's unprofitable and we leave it, and we end up giving stuff back. It's when something is profitable and you think it's going to end, that's the time you leave it. And again, a couple of weeks ago, I said that November's probably the last good month for premium on SPY, and now I believe that is more true than ever. So we do have to shift and start thinking about other things. If you had a Fed and nothing but a Fed, everything I'm about to talk about would be meaningless, because it wouldn't matter. It's all about the Fed. That's period. Well, it's not anymore. So let's go. FTX, that's the big story from last week. And what do we have? We have fraud, basically, is what it is. It's criminal action. It is using client money for investing in another company. Can't do that. You can't touch client money. And I think on Friday, they also reported that they were hacked. Another $370 million is gone somewhere. They don't know where it went to. Also on Friday, BlockFi, or was it Saturday morning? I'm not sure. BlockFi has now suspended all customer redemptions. No, you can't have your money back. Can't. So if you're a client and you had money and you open an account, you can't have it back. Imagine Interactive Brokers did that, where they said, oh, nobody can have their money back. Think about I want you to think about that for a minute. What would be your reaction to that? Well, nobody can have their money back. Now, the thing is, we don't know what else is going to happen. How many other smaller exchanges and smaller firms out there are going to be affected because of this? You have FTX, you have BlockFi that stopped redemptions. How many other people out there are going to say, I better get my money out of this exchange before it falls apart? Right? I mean, if Interactive Brokers told all its clients you can't have your money back, there'd be a run on E-Trade. There'd be a run on Thinkorswim. There'd be a run on every brokerage out there, because if they're doing it, it's only a matter of time before others do it. Maybe, right? So as far as the contagion effect of this, I don't know so much on Friday if the market had cared about that, or even priced that in, or even digested that. I'm not really sure. So that, and I don't know. I honestly don't know, but it's something that I'm certainly going to be watching in my news feed and listening to carefully, because I need to know where it's going to have an effect, because it could ripple into other areas that then cause bigger problems in other more traditional areas. I think back to 2007. I think it was the early 2008, beginning of the summer of 2008, Ben Bernanke was in Congress, and they were asking about the subprime mortgages. They seemed to be in trouble, and he said that it appears to be contained to the subprime market only, and he expects to see no spillover. So, you could say the same thing with crypto, that the washout in crypto that's probably coming is probably going to be contained to crypto and not spill over to other sectors. You don't know that. I don't know that. Nobody really knows that. Now, if Ben Bernanke, who, by the way, is at that time, was and is probably the world's leading expert on the causes of the Great Depression, and if he can't see something like that, if he was unaware of it and couldn't forecast that or see that, How can you believe anyone who says, oh, it's going to be contained? Long-term capital management, oh, it should be contained, right? Well, no, it wasn't. One hedge fund could have taken down a whole swaths of the market unless it got a bailout. What's going to happen here? I don't think that there was enough caution on Friday. I want to see what happens. Also, let's not forget that we have a cumulative effect in place, right? Inflation is coming down, but it's still inflation. We still have prices going up more than that 2% target, and you have to think about all of the cumulative effects of inflation up to this point as well. That does affect the amount of consumer spending that we would expect to see. And the cumulative effect of interest rate hikes to this point. They're not going back down. They're probably going to go a little bit higher and stay flat, but they are going to stay elevated for a period of time. So this is going to slowly work its way into the economy. So we have to be aware of how it's going to affect. The big thing here is how it's going to affect C for consumer. So what's going to start to become very interesting is any measure of retail sales. And we're going to get 5 big retailers this week reporting. It is their guidance. It is their guidance that is going to be important because C is the biggest component of GDP. Tech job cuts. Are there going to be more? Where's that headed? And I think that many of them could probably get jobs somewhere else. I don't know that this is going to show up in initial claims, but it is something to watch now. What's going to happen to, that is INIT, by the way, initial. I'll just write the whole word, initial claims. And are there going to be more tech job cuts announced? And is this going to fall over into other markets as well? So we know that housing market is in recession. We know the mortgage market is in recession. And we are expecting now that we're going to see a tech recession. The interesting thing about tech is if you look at the gains, typically the gains in or the growth in earnings on the index, they are typically led by 2 big sectors, with information technology being one of them. And if it leads on the way up, it can lead on the way down. So earnings now are going to be probably the thing that holds the index down from higher and higher levels is the concern about earnings as opposed to the concern about the Fed raising rates. 12-month forward EPS, we're going to pay attention to this a little bit more. 2023 over 2022, the expectation from Goldman Sachs is 0% growth. That 0% growth, your multiple is 14 to 16. We're sitting at 17.73. So if this narrative starts to get a hold that we're concerned about earnings, then the valuation on the index at this point in time is too high. However, you have incredible sentiment, and because of that, you're going to have short covering. So I don't know that I'd see Monday morning suddenly, oh, okay, this now is the big narrative, and we're trading down again. You don't get rid of that kind of sentiment that easily. In the UK. Hunt has said we need spending cuts and tax hikes. Well, spending cuts means the G component of GDP drops. Tax hikes mean consumers have less money, consumer spending drops. These are 2 components of GDP. And if that drops, well, that's all part of global GDP, and that's all part of growth, especially when you're talking about S&P 500 components that operate globally. Well, that's got to take a hit to earnings somewhere, and to revenue somewhere, right? Well, how many other countries are going to follow suit with that? China COVID cases. This is a bigger problem than what I think the market has priced it in on Friday. Here is 1-year COVID cases. These lines here, blue. These are new cases. There's the 7-day average. Here was your Shanghai lockdown. Here we are over here. November 12th, new cases 24,261. The last time it was that high was April 9th, 24,969, which was just over here on April 9th. And this whole period was the Shanghai lockdown. And look at that spike at the far end of the chart over here. Now I know that China has said that they are relaxing some things a little bit, but Are they going to go into another lockdown? And if they do, that's going to hurt some companies. It's also going to hurt supply chains again, because there are some things that are expected to come out of China. And if it does that all again, then that read that we had in November could simply just go out the window again. So we have to be concerned about this. These cases are going up. However, the election is over, but are they going to follow their zero COVID policy or reinstitute it to its extent again and go into lockdowns again? That's going to be interesting to see. And I think this is a bigger risk for Tesla than what was being priced in on Friday. In fact, you saw Tesla last week just dropping and dropping. On a pre-split basis, they were trading around 525. And if you remember the video I had done earlier in the year about the EV space, I had put a price target on Tesla at the end of the year of $480, and it was getting close to that 480, and I was going to do a victory video and a na to all those people who called me names. But the damn thing rallied. But I think that this is a bigger problem than what the market has priced in, because if you have another lockdown, remember what happened the first time. Tesla took a hit on that quarter. If you have another one, they're going to take a hit. Not only that, you have the Twitter problem, which is growing. Ad revenue is dropping. Companies are leaving quite rapidly. I found it interesting that GM was pretty much the first one to say, oh, we're going to stop advertising until we see what's going on. Well, of course you're going to stop advertising. I mean, you're not going to give the guy money that owns your competitor. You're going to pull your advertising under the guise of, well, we're not sure what the tone of the language is going to be. But right away, you could have said, well, I guarantee you Ford, GM, Stellantis, they're going to leave. And they did. But more are leaving as well. Well, that is their source of revenue. If that drops, this could be the quickest bankruptcy you've ever seen. The fired employees not returning. I guess they fired too many, and then they sent letters out saying, sorry, it was a mistake. Can you come back? And quite a few of them are saying, nope. Coders and executives, because they are in a market where they can just walk across the street and get another job. They don't want to work for the guy. The shine seems to be coming off him, right? He probably shouldn't have taken his political stance on Twitter saying you should vote Republican. He probably shouldn't have done that, given that, 99% of Twitter employees vote Democrat. So what do you have here? You have China, which is a big operations risk for Tesla. Because if this continues on, if they repeat what they did before, it may not be Shanghai, it may be another large city, but that will disrupt supply channels, right? So you have some operational risk coming out of China, and you have some price risk with Tesla associated with Twitter, because if he gets a margin call, he's got to sell more Tesla stock to get that done. So you've got two big risks on Tesla, which I don't think are being priced in at this point in time. You have China, which I don't think this concern is being priced in at this point in time. You have FTX and potential contagion. I don't know where it is, but it just would seem to me there should be a little bit of caution behind that. So these are three big things that I think that I'd want to look at a little bit closer, right? For the applied series, if you have the applied series in the bottom up folder, you will find Agency, AGNC. It's about 3.5 hours long, and what a beautiful play that was. Since earnings, it's only been 2 weeks since earnings, it is up 24%. 24%. I don't know that there's a better performer out there over that 2-week period. DHI is the next bottom up case study that we're going to do. For the bottom up series, it's very difficult to do a generic video saying, here's how you do a bottom-up analysis, because every subsector is different. So you really have to have a case study. Once you go through Agency, you should be able to go through any mortgage REIT. And mortgage REITs, there are two types, right? There's origination and servicing, which is what ABR is. And then there's those that just have portfolios of securities on their balance sheet, which is what Agency is. ABR is after DHI. We'll do ABR as well. But we're going to do a home builder next, which is DHI. The only way to do bottom up is to actually take an example company and show exactly how you would analyze an example company. What are the important line items to look for? what business is in. How do we get our head around how it does business? How does it generate revenues? What costs does it generate in generating those revenues? And what are the two big risk factors or three big risk factors associated with its revenues and its costs? And from there, it's a little bit of detail. But agency is now up. All of them are going to be around 3.5 to 4 hours, because that's just what it takes to get to know a company. And in fact, that's really not enough time either. I should have taken more time. But then I'd be diving into things that, as a retail investor, you probably don't need to know. The next video in the top-down sector will be yields and spreads, because these are good indicators from a top-down perspective, especially spreads. In the technical analysis folder, the next reading is going to be breakout stops and retracements. This will be up Monday or Tuesday. I've done my notes and my screens. I just have to narrate it. Okay, next two screens, we're going to take time on the SPY. So the first thing I want to do, because I have been asked to explain this more, is how do I deal with my positions? So I'll explain what I did to my SPY options position. You'll recall that I said that I had sold some puts from 380 on up, and I had sold some calls from 340 on up. So I had calls and puts. My break even at that time was 349 to 392. Well, we're above 392 on the SPY. We're sitting just below 400. And you can see this big green bar over here was November 10th. We just, on the release at 8:30, futures just jumped 100 points. And if you're trading options on SPY, well, you got another hour. You got to live with it for another hour. So what I did was I rolled up and forward. The first thing I did was I decided, well, what would be the new bottom on the market? Where do I think I'm going to find support? So you have three different support lines here, and I figured would be somewhere in this zone over here, which is somewhere between 365 and 370. So I don't mind rolling up my puts such that my break even, which is at 349, can move up into the 365, 370. Because the market had gone up so much, all the puts I sold were in the money. Well, I shouldn't say in the money, were way out of the money, almost worthless at that point, like really low cost, all of them under $3, $4 to close them out. So I closed them out at nice profit, which really, when you think about what you have left, is you have all of your calls that are underwater, but it's offset by the gains I got from the puts. So that raised my average cost. And I rolled them up 400 to 410. So I went from 380s, 382s, 384s, all the way up to 400 and 410 for December. Roll up and forward. Roll up because I get higher protection on the upside, and roll forward so I get greater time value at the same time. So up and forward. That changed my break even to 364 to 406 at this point in time. We're sitting at 398. So by rolling up and forward, I'm still at 398. If you think about this as a continuum, I'm somewhere over here. And if the market continues to rise, that's what I'll continue to do. I'll continue to roll these up and roll these up. I have a mismatch now because I have November calls with December puts, which means I have a decision to make before expiration on Friday. Do I want to roll my calls forward, or do I want to be assigned? That depends on the amount that I can get by rolling my calls forward. So if November is called from me, I will have an SPY short position. But the cash rate that I can get is greater than the borrow rate. Meaning when I have a short position, basically I'm selling stuff I don't have and getting paid for it. So I'm going to have a whole bunch of USD on my balance sheet in my portfolio. Well, that USD is going to earn a cash rate, and the cash rate is significantly higher than the borrow rate. So a short position will actually get me about 5,300 USD in interest over that period of time. On a 1.6 million short position, that is 5,300 USD that would come in. Can I get more than 5,300 by closing out my calls, let's say on Friday, and rolling them forward to December? The extra time value I pick up on rolling those calls forward, will it be greater than the 5,300? If it is greater than the 5,300, it makes sense to roll my calls forward. If it is not greater, it makes sense to get the cash rate. I will let the value of the options dictate it. Implied volatility is 18.8 on the S&P. So that becomes, so it's not such an easy decision to make. You have implied volatility that is low, and you have a short-term cash rate which is very high. It's not a straightforward decision anymore. Just a little while back, a month in mid-October, we had implied volatility of 0.3. You rolled forward. There's no cash rate that made up for that. You rolled forward. Well, we're down to 18.8, and where are we going to be by Friday? Look at the implied volatility percentile, 52 weeks, 27. 26 is 9, 13 is 11. What this is saying is that 91% of all observations in the last 26 weeks were above this rate. And this 13 week is saying 89% of all the observations of implied volatility in the last 13 weeks, in the last quarter, were higher than 18.8. You have very low implied volatility. Time value is not that great anymore. I felt fairly certain a couple of weeks ago that November would be the last good month for premium. Rolling forward at this point, you're rolling forward at lower and lower premium. Doesn't seem to make a lot of sense, but I think I will exit 2022 with no options open on the S&P. I think this is it. This last, as soon as this last position is done, I think I'm out. Where could we possibly go here? We have the 200 moving day average at 407.16, which is basically, we're at 398.51. We're about $9, $8.50, $9 higher. So that's about 85 to 90 points on the SPX, below the 200-day moving average. We have our trend line here, which is our resistance, a longer-term trend line at 411.85. So you're going to hit some resistance at the 200 moving day average, or the 200-day moving average. If you break through that, especially on increased volume, then you could be looking at 4150, maybe even as high as 4200 on the index. And if there is any sell-off, I can't see being able to punch through this zone, this 365 to 370, unless we have some clear indication that the Fed is actually, because of this rally, now forced to go 75 in December. So if they come out and actually say that, guys, I'm sorry, but we got to go 75 in December, most likely, if you keep doing this, then suddenly the Fed is the number one game all over again. So we'll see what happens. If I do get a short position, by the way, I do have to be careful of something, right? You have, yes, I'll get a cash yield by having a short position, but I got to be careful I don't give it back on the dividend. The ex-dividend date is going to be December 14th. If I, extrapolate out from these dates, December 14th, but I've got to watch when the ex-dividend date is, and I got to make sure I close out this position before the ex-dividend date is. The expiry is December 16th. The last payment was on September 16th. If it follows suit again that the next payment is December 16th, that means the ex-dividend date will be the 14th. I'll want to be out sometime on the 12th to 13th if I have a short position. If I do have a short position, then I would probably roll that short position. Whatever my average cost is on SPY would be my strike price on January in terms of selling calls. I'd rather not do that. I'd rather not. So I'm hoping the market will give me some opportunity to manage that position downwards. What I am doing, and what I did on Friday to quite a bit of success, is as the market opened on Friday, let's say that this was the closing price, it did play around with the zero line for quite some time. I was buying 400 calls for November 30th. Oh, I already wrote it down. There it is. I was buying November 30th $400 calls on every pullback. And I was able, I say every pullback, I was able to do it twice. Buy the call, sell it at a premium, buy the call, sell it at a premium. And when I buy the calls, basically I'm hedged at 400, right? They were costing 480 to buy. I put my bid in at 480 and I was selling anywhere between 650 and 670 on these, but I was buying them in bulk quantities, not just one or two at a time, but in bulk quantities. So I will do the same thing on Monday. and during the course of this week is that on any pullback or any weakness, I won't hesitate. I will buy the $400 November 30th calls. At $4.80, if it doesn't work out and the market does drop, well then great, because I do have a total short position when you count the amount of calls and puts I have. I am negative on the SPY. That will only help me on the way down. Since I rolled forward on the 400s, 410s, brought me to 364.59 on the downside. I don't think we're going there. That is the lower part of this zone. If anything, we might, if there's any fear, I don't know that we get much past 38.50. So I feel comfortable on that. And it would only add $4.80 to my cost, which would lower this by 480 and lower this by 480. I'd still feel pretty good. So I would be buying the November $400 calls on every pullback. Now I'm doing that because I have a greater position, of which that becomes an incremental position for. This is not an absolute position in the sense that I have nothing going on and I think that would be a great way to make money. It's that I have something else going on and I think that's a great way to lower my risk if the market presents me the opportunity to lower my risk. So don't copy me. Don't just go buying November 30th 400 calls because I'm doing it. I'm doing it for a particular reason, not because I think that, oh, that's a great thing to do. In the Q&A I had, I think last week or the week before, somebody asked me about agency, and I said I was buying agency under $8. Well, that's an absolute position. That is something I'm doing without regard to anything else I own. And that turned out to be a good thing because agency finished at $9.65. Again, 24% increase since its earnings. And on the morning of its earnings, really, it dropped all the way down to like $7.30. You have to be a buyer at that point. It just didn't make any sense given the earnings that they had. So, I bought. And it's now $9.65. I don't know what to do with that. I don't know whether I'm going to sell that. I don't know whether or not that was just a party that the market threw for everybody, and mortgage REITs had been sold off so hard it was just a beautiful bounce. But this, when I say something like this, that is an absolute play, meaning that irregardless, is it irregardless? Or no, sorry, regardless, irrespective and regardless. I just made a bad mistake, irregardless. I can't believe I said that. Irrespective of everything else I have, I would have done that. However, this is respective to everything else I have. So unless you have everything else I have, this type of strategy is not something I would recommend just to do for a quick profit. Let's be clear on that. Okay, let's have a look at the S&P again in terms of some fundamental levels. Fundamental in terms of multiples of earnings, and fundamental in terms of the type of narrative that would dominate. We have a forward EPS, forward four-quarter EPS of 225.20. We'll have a look at the this week in earnings shortly. SPX close at 39.92 gives us 17.73 times forward earnings. There we are. So I've drawn 18, 19, and 20, and I've drawn 17 and 16. Personally, by the year end, I don't see 20, and I'm not seeing 16. From where we stand right now, I don't see 16 because I just don't see the sentiment getting there. I don't see 20 because valuation concerns are going to be huge. Because we have damaged the economy with these rate hikes. It is not the same economy we had 2 quarters ago. It is got more headwinds to it. We are seeing a 2023 forecast for earnings at 0% over 2022 from Goldman Sachs, and more analysts are all, every time I hear them on Bloomberg, it's always the same thing, is that earnings still haven't come down. They're going to have to come down. We're going to see earnings come down. The multiple has come down. Now earnings have to come down. That's becoming a bigger and bigger story, and the further up you go, the louder that narrative is going to become. So I don't see 20. In fact, I'm not even sure I see 19. What's going to keep a ceiling on the price is, again, as you keep going higher, the economy and earnings are going to be a louder and louder conversation. Valuation concerns are going to show up. Fed's not going to want this either. I think the aggression at which they speak will be directly proportional to the level of the index, that each point up will be a louder and louder Fed. And it may put the market in a position to force another Jackson Hole speech. That if they continue on, you may get another one of those. Because remember, Jackson Hole came off an inflation reading in July that showed zero inflation. Right? And the market just kept going up and up and up, and financial conditions kept loosening and loosening. And that's when Jackson Hole happened, where he said, you're not making this easy for us. We now have to work even harder. It's not done. We had one good reading, which was not 0%. July was 0, and we get Jackson Hole. This was not 0. It was good. It's in the right direction. I do think the Fed was going to slow down anyways, but they're going to have to come out with a shotgun and point it at the market and say, no further. You take one more step, you're going to force us to unload here. So, the market could force another Jackson Hole moment. We got to be careful about that. Pay attention to this over here. So I think that this kind of puts a ceiling to how high we're going to go. However, I think this kind of puts a floor to how low we're going to go. I think sentiment, you just can't put a bullet through sentiment right now. On Friday, that there was no concern about any contagion from crypto, no concern about the rising cases in China and how they're going to react and what that could possibly do, that there was no concern, sort of suggests that you have sentiment, you have a tailwind of sentiment and the belief of this rate hike cycle. So I think we're somewhere between 17 and maybe 18 and a half, 4,100, maybe 4,150 to the upside, and you get to there, I guarantee you that will be loud. And the probability will probably start shifting towards a bigger rate hike in December, just based on the Fed saying, you've undone everything we've done. We've already seen mortgage rates down 60 basis points. 10-year Treasury down 35 basis points. The 2-year, 3-year, 5-year down, 40 basis points. These are rate cuts that the Fed does not want to see at this point in time. That's where I think we are, but with implied volatility at 18.8, I'm not that excited about selling calls or selling puts on the index. I'm going to wind up the positions I have now. I'm working my way out of that position, and I think I'm done, and I'm moving down to the individual stock level. For example, I've already pointed this out with the agency, but mortgage REITs, the tangible book value per share is going to increase as rates drop and as rates volatility drops. We've already seen rates drop. That is a positive for book value of REITs. And if rate volatility drops, the spread between an MBS and a UST shrinks. And if the spread shrinks, remember level 3, if you're a credit investor and that credit spread shrinks, what happens to the price? Up it goes, right? So we have a good environment for that, regardless of what the economy does. See, mortgage REITs don't depend on the sale of homes, because they buy bonds. They're not mortgage originators, so they don't really care how well the mortgage market is doing. They don't care that the mortgage market is low. As long as there are bonds that I can put on my balance sheet, that's all I care about. We have to get more in tune with what to buy and move away from the SPY. But we still must pay attention to the SPY in terms of, if the market's going up, it's going to drag stuff with it. And if the market's going down, it's going to drag stuff down with it. So where are levels on the market that we can feel comfortable with? And that is, from where I stand, that is my best guess as to where we're going to trade. I think right now, the focus is going to be near term. The focus is going to be on the 200-day moving average to the upside, but with our eyeballs over on China and FTX to see what happens there. Okay, this week in earnings, November 11th. Here is our chart of the S&P 500 Q3. This is for Q3, the quarter we're in now, the 2022 share-weighted earnings. And way back here, these are estimates of what it would be. It's normal to see estimates come down in front of the quarter, and then once the companies start reporting, up they go. This has not followed suit. In fact, it's the first one that has not, since we've been watching it, that has not followed suit. So we are at some inflection point in terms of earnings growth. We have crossed that in Q3. So the forecasts of lower earnings per share for 2023 seem consistent with this inflection point, suggesting that 2023 over 2022 will have zero growth, I think is probably a baseline that we can work on now, which means as soon as this sentiment disappears and we start to think about earnings and the reality of it, I do think that our multiple on the index is probably going to go lower. But I don't think we're there yet. I don't think the sentiment is there yet. Let's go down and look at our earnings forecast. Here we are here, forward 4 quarters, 225.2. And the 2023 is now down to 231.32. So that has dropped quite a bit. The calendar year 2022 sitting, the forecast is for 220.38. You've got almost 3 full quarters in there, plus your forecast of what the fourth quarter was. And Goldman is saying you're going to have zero growth, which means this 31's got to come down to 220. 15 times a 220 is 3,300, right? So 3740 is 17 times 220. That's 34. What did I say? Yeah, 3740, which is a good 260 points below where we are right now. Let's see who is reporting this week. Negative, where are we? Monday, you have Tyson Foods. Where are the big ones? Look at this. You have a big day on Tuesday. Home Depot, 8:30. Target, 8:30. Walmart, this is 9:30, but we'll get it before 9:30. Home Depot, Target, and Walmart. And it is their guidance that is going to be more important because that is where we're going to get the effect of what we saw in November. And if you have goods deflation, well, that's what they sell. They sell goods, not services. They sell goods, so it's their guidance that are going to matter because it's going to be a weight on their revenues. So when this is released, see if you can get the report. Go to their websites, get the report, see if there's any forward-looking statements. Typically, I think for the MD&A, you got to wait until they file their 10Q, which usually is the day after, either later that day or the day after they file the 10Q on the SEC site. Then you can actually go to item 7 and listen and read the management discussion and analysis, or just tune into their conference call that day. There are 3 of them reporting. I think it would be worth the 3 hours to listen to them to see what they have to say. Who else have we got here? Lowe's, TJX, Bath and Body. So you've got a bunch of retailers this week. NVIDIA, that'll be interesting. And Applied Materials, Ross Stores. And I think that would be it. Yep. So retailers this week is heavy in retail. So I would be paying attention to their forward guidance. I know I'm going to be paying attention to that. It'll give me some flavor of what I can expect for the consumer and how the consumer feels and how they think the consumer feels, because honestly, they're in a much better position to assess the consumer than I am. So to me, they are experts, and I have, 8 experts reporting on the consumer this week. Okay, let's have a look at what we have as of today at 4:30. This is November 13th, Sunday, November 13th, Waller. On the 14th, you have Brainerd at 11:30. I really am interested to hear what they have to say. November 15th, PPI. I don't know that that's going to have as much of an effect as CPI, even if it came in hotter, showing inflation at the wholesale or the business level. I'm not really sure it has the same effect as CPI, because that doesn't necessarily translate into prices in the end if you have productivity gains between when you buy your stuff and when you're finished manufacturing your products. So it's not as clear a signal, but be aware that you do have PPI at 8:30. You have some more Fed speak here at 9 o'clock, 10 o'clock. Barr is the I think vice chair for supervision. This is testimony. It's a 2-day thing. I don't know that that's going to be the same as listening to Fed speak. Canada, you have your inflation, or we, I say we, 8:30, 8:30 a.m. The Canadian dollar is at support, or I should say the US dollar is at support. Canadian is at resistance, 132.50. A couple of weeks ago, I said I think that the if CPI came in below, we could probably see the Canadian get to its 32.50 point. It is at 32.50. It's going to be dictated from here by the direction of the DXY, and this will have some effect as well. What would be really bullish for the Canadian now is we had US CPI come in lower than expected. Well, if this comes in higher than expected, well, then long and strong the Canadian dollar, right? This is going to, as I say, be more important going forward. Retail sales, all eyes on the consumer now, because the consumer will make or break the economy. And this is for the month of October, and we've seen CPI for the month of October, goods deflation. So retail sales will take on some meaning here. So I think a lot of attention will be paid to this. Keep going. You have more Fed speak here. Williams. You have your housing market index. And we know that we have a housing market in contraction. I don't know that there's any incrementally new information that's going to change much here. Waller, going into November 17th, building permits. You have your housing starts as well. Fed speak, followed by Fed speak. Keep going into November 18th, leading index and existing home sales. Not too much once you get into Thursday and Friday. For Canada, our big event is CPI. And for the U.S. markets, it's going to be a combination of what is the Fed going to say and what a retail sale is going to look like, along with the guidance we get from all of those retail companies that are reporting. So the consumer has now been elevated this week to something of importance. So let's start measuring the health of the consumer. We have some good data points to get that done this week. And if you're long the Canadian dollar, well, be aware that you have a risk event at 8:30 on November 16th. That if you're nervous about this, if inflation comes in soft, the Canadian dollar is probably going to take a hit. So if you are long the Canadian, yeah, you'll take a hit. If it comes in hotter than expected, well, up we go on the Canadian. Or, if you're playing the US CAD pair at 132.50, down we go. We might see 130. I don't know that we would get much past that. I think 130 is where I would probably think about shorting the Canadian dollar at that point. But as of right now, I still have my long position on the Canadian. I've lightened up a bit on it at 132.50, but I still have it in place because the DXY direction is down. So I think Monday and Tuesday I might squeeze out some more gains on the Canadian. I don't know. It's the game we play, right? We play the future. The future is unknowable. All we can do is say, based on what I know, I think, I feel comfortable taking on this level of risk. Anyways, that's the week. We'll wrap it up here, and Wednesday will be the Q&A video.